Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with a Forex strategy video, and we're going to talk about an indicator that I use very often and I find quite useful for a number of reasons. The average true range, or as you'll often hear it referred to as the ATR, is a measure of activity for the markets. This is very important when we are looking at FX, which doesn't have a centralized exchange and therefore does not have very good volume indicators, and also as a measure of volatility. All right? And a lot of people reference the volatility figures that we like to use in Daily FX. We have access to a number of things. We also have a couple proprietary measured volatility indicators, including the FX Volatility Index, but we can actually use this ATR as a tool that replicates volatility. It's a very good measure of this, in fact, and that in turn can be used into your trading to significantly improve accuracy in terms of establishing when we're having breakout range, trend, momentum development, and a number of other aspects of your trading. So let's take a look at this versatile indicator, and I'll show you exactly how I use it, and we'll look at a particular number of pairs and markets which have some interesting ATR readings right now. The first thing to assess, there are three general states that the ATR can really be used for and improve our trading. One, it measures just simply activity levels. All right, it's important to assess and realize it does have this measurement ability. Two, it actually has sometimes a gauge of directionality to it. Just like implied volatility. Remember, when we look at the implied volatility measure or the VIX indicator versus the S&P 500, those two have a fantastic negative correlation, meaning when the volatility index picks up, the S&P 500 most oftentimes drops. All right, so that's a useful aspect to this indicator as well. And then we also have downshifts and upshifts in volatility. This is important. This is more of the level of changes volatility, which is essentially like saying going from range to breakout, from seeing a trend that is just starting to really gain traction and build momentum over time, or lose that momentum and give you the first signs of an initial reversal. All right, there are many aspects to how we can use this, and far more than what I'm just going to talk about here today, but I'll show you why I find it particularly useful. Now, I think it's important to see the actual indicator itself at work on a particular pair. This is the dollar-yen versus the 20-day average true range. Now, the average true range is calculated in a very simple way. All it is the daily range of every one of the bars that we've had for how many ever days we're going back. This, we're actually going back on 20 days. So we'll take the range of these past 20 days and we'll average it out. So, for example, we can see this session here from Monday was very, very narrow. High and low. All right, you can see it was essentially 30 pips. Wow, it was a really narrow day, really inactive, very quiet. We put that into context with all the other 19 past previous trading days, and you get a measure of activity that looks like this. All right, very, very quiet. And you can see how it's developed over time, and you can change the time frames. This is 20 days, but what if I changed it to a 1-day time frame? All right, I can just alter this. We'll make it 2. Well, let me go down to 1. So 2 trading days. All right. When we take into consideration the Thursday, Friday of last week, huge jump in activity, but then you have today's, which is extraordinarily quiet, just like the prior breakout effort that you had into Thursday, Friday. So it is a good indicator for many different reasons, as you can see just on this one example. But let's take a look through its individual rules. First, I'd like to take a look at just using it as an activity gauge. We looked at it a little bit on the dollar-yen, just only going back maybe 4 or 5 months, but this is an activity gauge for pound-yen, going back over the past 7 years or so. This gives us a very good assessment of this development over time. You can see huge spikes when we did have a very high level of volatility, which coincided nicely with this really big drop. Same with this mid-2010 when things were really starting to deteriorate in Europe. All right, and nowadays we can see that there is more of a positive correlation, which is unusual. All right, we'll talk about correlation in just a second, but you can see once again there's a deviation, a very interesting deviation. All right, and this is a 20-day ATR. Recently, the correlation has been positive, or at least it has been since about the mid 2009. But this is perhaps one of the biggest deviations we've seen since this huge spike to the positive side, though we don't usually see moves to the downside that deviate very long. This is perhaps an indication that conditions are going to change. We change our time frame. This is the average true range of the past 5 days, or one trading week. And as you can see, we are stepping down very quickly, right, for the pound yen. And that's a dangerous position to be in when we look at this kind of congestion. In fact, I have the daily chart of the pound yen up, and you can see that we've worked our way into this congestion pattern, where it's essentially from 159.25 down to the floor down here at 156.75. A very narrow window for this typically very active pair, which even on the 5-day rolling average has a daily range of about 100 pips. So we can cover this entire range within a couple of days, and subsequently this tells us a breakout pressure is coming, a good activity gauge, right? And we can use it as such. This is a ATR in progress of a directional measure. I like to use the S&P 500 as a very good benchmark for this aspect, because it is perhaps one of the more well-known uses of this particular indicator. And that's where the ATR and VIX index are used well in conjunction, because the ATR actually gives very similar readings to the volatility indexes that we typically like to load for you. Now, this is the ATR as it is right side up, so to speak. If I were to flip this indicator upside down, you can see how the big drops coincide, or the big rises in ATR coincide to the big drops in the S&P 500. Why would that be? Well, this is an indication that the declines that we have in the S&P 500 are far more dramatic than the increases. This is how the relationship is between activity, market level activity, and measures or markets that are risk sensitive. So the S&P 500, when you have risk appetite rising, activity levels decline and S&P 500 rises. Right? But when you have a risk aversion sentiment where fear is predominant, there's typically a bigger move to unwind those risky positions, and subsequently there is a big pickup in activity and a drop in the index. Now, this is not just unique to the S&P 500. This just so happens to be also a positive correlation to the same currency pair we were just looking at, the pound yen. Right? And this is actually going to be an indicator that is very similar across all the dollar or all the yen-based crosses, because it's a carry trade pair. Right? Carry trade has a very negative correlation to volatility, because volatility is bad for a carry trade. It means that the carry that we would expect to pick up, daily income, very quiet, very calm, very passive, is going to potentially be offset by changes, sharp aggressive changes in the exchange rate, which is a risk. All right? So when I go back to this longer term comparison between the pound yen and its 20-day moving average, or 20-day ATR, typically we wouldn't expect these positive correlations, because it just so happens to be so quiet that we do have that positive. But as you can see, normally speaking, you have a lineup of where activity actually increases when the market's dropping. Now look at this indicator once again, and we'll look at it in normal position. Look how low it is, and remember how we are positioned when we are talking about the pound yen. All right? That pound yen cross has worked itself into an exceptional rise, and subsequently is now in a congestion pattern, potentially looking at a breakout. Right, so those directional indicators can be very useful as long as you are looking at the pairs that have the correct relationship on that particular aspect of the market. All right. Now, the change in activity can be very useful. When we look at, let's say, a pound yen, which is incredibly quiet now, but that can actually be a measure of extreme. this might be too extremely quiet given the conditions that we have in the underlying, and also with event risk. When we look at the economic docket for the UK, we know that event risk is going to pick up, starting with Tuesday's CPI figures, and then really kick in on Wednesday's jobless claims and BOE quarterly inflation report. So you put that entire picture together, and you have a complete picture. All right? Market conditions have essentially been assessed by this ATR indicator. So we have very different readings on this. We can call this an extreme low, but we can also see degrees of activity both increasing and decreasing. For the dollar yen, which is another yen-based cross, you can see that we are working our way down to our lowest level since the beginning of the year. All right, these are the most quiet conditions that we've had since the beginning of the year, and that creates some tension as well. We have a nice wedge pattern, just like the pound yen, and I have these boxes here because they relate to the Bank of Japan stimulus program. This big lead up in the yen started a number of months before the actual stimulus program was introduced. And guess what? It started around September, October. We are at November, and we are expecting another stimulus program probably at April or around April, when the Japanese government decides that they're going to, or the Japanese government puts the pressure on the Bank of Japan to actually induct a second round of stimulus. All right? So we have a similar situation in many circumstances, including the really low activity report, where it doesn't stay this low for very long. All right? So that's a good indicator. We looked at the pound yen, but what if we look at a couple other pairs outside of the yen crosses? Pound kiwi, off of many people's radars, but look at this technical setup. You have a descending trend channel where you have a nice rising floor of lows. It's easier seen on the 8-hour chart. All right, you can see that descending channel and the technical pressure that we are currently facing. A possible reversal or a possible break to the outside, regardless of direction, it's actually a break consideration. There is breakout potential, bullish or bearish. All right. So when we go back up to the daily chart, looking at the average true range figure, you can see that these markets are excessively quiet. They're the most quiet we've seen since way back here. All right. And look at the conditions that we had back then. You had two opportunities of first this reversal and then subsequently this break to this aggressive move. It's not a guarantee that you're going to have the same thing this time around, but it certainly does add another piece of information to that assessment. Another pair, Aussie Kiwi, off the beaten path. All right, we can do this for all the standard pairs, but I encourage you to do this yourself. This is another pair off the beaten path, Aussie Kiwi. You can see the 8-hour chart here, the congestion that we have here. Very, very tight, remarkably tight. When we look at it on a daily chart, we end up with a number of dojis. All right? Very unusual to see this in a technically speaking, and you can see that when we assign it a longer term pattern, and you look at the average true range, conditions have been quieting as this wedge has set up, and that is more likely to coincide with an extreme low and subsequently lead us to a breakout. Now I'm looking at shifts that go from inactive to potentially active, but we can go back the other way as well. When you see big trends that are going to eventually become, let's say, a range. All right? S&P 500 has been one of the big arguments for this one. We had really big active markets, but they steadily declined in terms of activity between their subsequent pullbacks. All right? So the pullback we had here in 2011, and as it started to revive its run to the upside, you had a rapid cooling in price action, which eventually set up the next correction. All right? Right now you've had very, very quiet conditions in general. We move it up to the 20-day. This is actually a 10-day. You can use any time frame you want, but you can see that once again, conditions are quieting, all right? Which is not very conducive to this consistent run to the upside. If this is not going to be a very impressive move, if it doesn't have a lot of momentum to it, it can actually turn into a stalled bull trend and subsequently instigate the next turn. The question is whether the next turn is going to be a shallow move or a much deeper move. All right, that's where we have to add in the additional technical fundamental considerations, but this ATR gets us very close. Hopefully that helps you out. And there are many other indicators that you can use and incorporate into your trading, but the ATR is one of the ones that I like to use very often when I do my technical analysis. So hopefully you can start using it within your own trading and use it to a high degree. Thank you for joining me today, guys. We'll do another Forex strategy video tomorrow. Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with a Forex strategy video on a topic I believe we're probably going to cover a number of times between now and next week, and that is the taper speculation. Now, this has become an exceptionally important fundamental theme. I think that next to risk trends, the relative stimulus efforts by the central banks of the world has become the most market-moving potential for currencies. But we are contradicting a market condition in which December, or the final weeks of the trading year, is a drawdown on activity versus a time when certainly speculation against this stimulus theme is really starting to pick up. So it creates a very interesting circumstance where volatility can pick up, but can necessarily trend get to its full gait. All right, and that's going to be an important question that we have to answer when we look at the dollar and generally risk trends going forward. So I want to open up our conversation looking at the US dollar, and this is kind of a strong reflection on the indecision that we have, despite the pickup in speculation related to the Fed's plans for monetary policy. You can see here on this Dow Jones FXCM dollar index that the greenback has traced out a 70 pip range. All right, very tight, very consistent for the past 12 active trading sessions. Highly unusual. Highly unusual. Either I would expect a risk theme, a positive risk theme that has reemerged, to break the US dollar to the downside, or I'd expect the pickup in taper speculation to really drive the US dollar forward. Now, we can see in the taper speculation that we've been moving between three general time frames by which the markets have been pricing in a move from the Fed. All right, that first move from the Fed, and I actually have them highlighted here. All right, originally it was September. The September rate decision was fully priced in through forward guidance, and it sent the market for a tailspin. Surprisingly, a drop in the downside for the S&P 500, but also a rally for the dollar when it was known that they were in fact extending the taper. That was, or actually it was a drop from the dollar and drop in the S&P 500, which is why it's so unusual, particularly from the S&P 500 side, when they were announcing that yes, indeed, they were going to defer the taper, something that the market had already priced in, and it was assumed that the Fed had committed to a general theme to allow the market to get to that speculative approach, because in the lead up to that actual taper, the equity markets were improving. All right, and they subsequently fell after it was known that they were going to defer the taper. Maybe they prefer to avoid uncertainty. Nevertheless, after we had the September deferment and we had the early October government shutdown, there was a belief that December would not be the time for the taper, but instead way out into March to allow a few more months of data to see an improvement in expectations or improvement through performance in the data, and then subsequently see the transition from the old leadership, Bernanke, into the new leadership, potentially Yellen, and the new voters that come into the FOMC board. In fact, that speculation was pretty well reflected in the market, and you can see it not necessarily just in performance of these assets, but I have here a pretty easy measure. This is using Bloomberg. There's a news search item that you're able to find searches specifically for, and I looked for September taper, which was the green line here. As you can see, a lot of speculation around that, and it was building and up until the September 18th disappointment or deferment. All right, and then subsequently after that deferment and the government shutdown, speculation began to peak that the March taper would be the ultimate time frame. All right, and as you can see now, that December taper is getting less interest, or sorry, the speculation is getting less interest in the December timetable seems to be peaking. All right. Now, the December rate decision is scheduled for the 18th. That is next Wednesday. There is plenty to draw from when we're talking about data. We're talking about policy officials and the commentary that they have used, the forecasts that they have provided in their statements and in the beige book, and there is plenty to support this. There's also a consideration from looking at this problem from the Fed's perspective. If they're trying to manage the market's reactions, December might actually make a lot of sense. Why not move on monetary policy when you know that December is the quietest month of the year? You typically see risk aversion stamped out because you do have a positive performance on average for the capital markets, and activity levels are the lowest. So with only 3 full trading days left after the December 18th rate decision, perhaps that's the best way to make that move and then give the markets a good long time to assess how this will impact their positioning going forward. All right, all that speculation, but you can definitely see that speculation starting to instill itself in the price action of the markets, at least in the financial media at this point. Actually seeing it instill itself in the market is actually a little bit more difficult. We see that the S&P 500 is marching higher, which would naturally contradict expectations of a taper because there has been a material support in capital markets due to the assumption of more stimulus, right? Not just the Fed stimulus, but global stimulus. But you would expect the major supplier of that life-giving support to be a detrimental outcome, and yet we can still see that the the S&P 500 is up on Friday after the non-farm payrolls, which would have supported a taper, as well as a little bit of follow-through today, though not breaking materially to new highs. The U.S. dollar has also seen a little bit of a pullback through the end of Friday's session, and we are seeing that there is really a lockdown on continuation one way or the other into today's session, Monday's session. So this speculation will continue, and we will see that it gains more traction, but the question is whether this traction on a taper in December or a taper in the opening months of next year or the opening quarter of next year can materially drive capital markets. If we see that there is indeed a high probability of a taper, the market runs to that assumption. Will we see the U.S. dollar break to the upside? All right. Will a Euro USD ramp to the upside suddenly find itself to be overbought and see a reversal to the downside? Will the pound dollar do the same? Look at what the pound has been able to achieve on its own ramped up interest rate expectations. They're not going to hike until probably mid-2015, and yet the pound has done exceptionally well through the just material lead up in expectations. So would the dollar be able to accomplish the same thing? Or perhaps we see that the December taper starts to fade and the normal conditions, the normal seasonality effect of a pickup in risk appetite and a drop in volatility fears start to rise and the risk element starts to improve. If that's the case, maybe the dollar can decline, but more importantly, the markets will start to seek out the low burden, easy to assume, undervalued yield opportunities. And if that's the case, combining dollar and a low valued yield currency, Aussie USD might be the way to go. All right, so I don't think we have a clear fix on the assumed probabilities of what the Fed is going to do next Wednesday. But more importantly, I don't think that speculation has been able to come to a common forecast. Right? That common forecast is exceptionally important. All you have to do is look to what happened to the Japanese yen in the lead up to the BOJ expectations. Right? Monetary policy forecasting has a lot of influence over trading. Right? But we have to see a common consensus if we want the markets to drive us one way or the other. especially before a very important decision like that. So we'll keep an eye on this US dollar. If you see it make a move, don't immediately presume that it is a clear signal on taper speculation. Use the dollar, use the S&P 500 as a confirmation, and obviously you can also use gold. Gold is a third bearing on that. All right. Use these three in conjunction. You can get a very good sense of the taper speculation. But one thing is known very well. You need a dominant theme to provide you with any kind of medium-term trend. Anything beyond just a short-term breakout on the dollar or anything else in these kind of market conditions, in this final month of trading that is exceptionally quiet, requires meaningful fundamental support. We need a taper speculation, we need a risk-based move, something along those lines to actually find follow-through. So keep that in mind. Watch this speculation. We are certainly seeing it shape up in different places, and we'll definitely be keeping an eye on it for you and try to signal you when something meaningful has happened. Good luck trading, and I'll talk to you in the Forex strategy room once again tomorrow.